Hello, America. We are back on RadioFreeMarket.com. And, Bob, I'm going to let you finish that thought. You were explaining Austrian business cycle theory.
Well, sure. So market prices help coordinate things, and the interest rate is the special price in the Austrian view that balances how much households are saving with how much businesses are investing and what certain things they're investing in. And so if the interest rate is pushed down, the Fed wants to have an easy money policy, thinks it's stimulating things, and has an artificially low interest rate, that gives rise to a period of apparent prosperity, but it's false. It's an illusion that various sectors are all expanding, but households aren't really saving more. So the restaurants are booming, the factories are booming, everything looks like it's growing, they're hiring more, so unemployment goes down. So everything seems great, it seems like the good times are here, but it's based on an illusion, because by the Fed just writing checks out of thin air, they're not really creating more savings, they're just putting inflation into the system. And so in the Austrian vision, the economy gets out of whack, right? The various sectors of the economy aren't meshing with each other physically anymore, and so it's unsustainable. So at some point, you're going to hit a wall, so to speak, and then total output has to drop, and the economy has to kind of pull back and regroup, if you will. And that's what we know as a recession, where the sectors that expanded too much, they need to contract, they need to lay off workers, shut down factories, and so forth. And so the economy as a whole is kind of, one guy refers to it as recalculating, or somebody said it's like when you're using your GPS and you make a wrong turn and your GPS has to kind of recalculate for a minute or two. So they're saying that's what the economy as a whole is doing during the recession phase, because it was on an unsustainable trajectory before. And it's a painful process, and especially if you're somebody who got laid off, you want that to be over very quickly. But the point is, modern complex economy, you can't just have people in Washington saying, you go do this, you go build a bridge, you go fill potholes, that they need market signals to tell them where to go to contribute the most. And so, the government needs to just sit back and let the economy work out those problems. And in particular, the government needs to stop fueling the next boom, because that's what keeps causing it in the first place.
Mm-hmm. And if you look at it this way, as you say, the interest rate coordinates production, if you mess with the interest rate, you mess with production. Production becomes disoriented. So you wrote a great article, and I love it. It was, I think, published 2 years ago, relating the Austrian business cycle theory to sushi. So I'll just let you go at it. Could you kind of summarize that story for our listeners?
Sure. So, it was a piece at Mises.org, and the name of the article was The Importance of Capital Theory. And this just coincidentally was the piece that Paul Krugman on his blog, when he referred to me once, this is the piece he linked to and said that, this is the best exposition of the Austrian view, but it's still wrong because of X, Y, Z. So what I did in this article is I was trying to explain Austrian business cycle theory, and rather than just give the whole theory in words, I thought I'll just do a little fable or a little story to just try to show the logic behind it. And so I said, imagine that there's this island somewhere, and that, I was trying to be funny. I said Paul Krugman gets washed up ashore because he had a boating accident or something, and he meets these villagers, and they have a very simple economy, and they have some people who go out in the paddies and gather rice, and they have other people who go out with their boats and their nets and they catch fish, and then they have other people who take the rice and the fish and they make sushi every day. And I said that, there's 100 people, and I made the numbers all work out that there's 25 people getting the rice, there's 25 people fishing, and there's people who make the sushi, and then there's people who their job is to maintain the boats and the nets, right? That they have, like, the nets get frayed over time, and so they got to tie them together, and they have to wipe the barnacles off the boats or whatever. And so that's a sustainable economy. And so I said, Krugman comes along, and then he has, basically he takes workers out of maintaining the boats and the nets, and he has them go out and has more people now fishing, and then more people going and getting rice, and more people rolling sushi. And so if you did that, the total amount of sushi rolls that were produced every day could go up, right? Because now you have more workers in each of those sectors getting fish, getting rice, and rolling sushi rolls. And so for a while, output would seem higher, right? That each person in the community would be able to eat more sushi rolls per day than they did before. So they're going to think Krugman is a genius. That, wow, he just somehow magically created more sushi per day. The consumption would be higher. So that would be like their boom phase. But the point is, just Paul Krugman showing up and barking some orders, that's not made the economy actually richer. There's not more physical stuff there. What happened is the economy now is on an unsustainable trajectory because now they don't have as many people maintaining the boats and the nets, and so the nets are over time are getting more and more frayed. The boats are developing leaks and so on, and so at some point that economy is going to hit a brick wall when a boat's is going to sink or a net's going to burst, and then all the fish are going to fall out. And so at that point, their consumption is going to just fall off a cliff, and they're going to realize that that boom period was artificial. And then once that happens, once they hit that so-called recession in this little story, I said that you can imagine that the elders of the village are going to say, whoa, everyone stop. Okay, we need to regroup. You guys, we need a bunch of people now working on making boats and nets. And in that recuperation phase, when they have some of the people who know how to make the boats and nets are doing that, a bunch of other people aren't going to have anything to do, right? The people who normally would have been taking the boats and nets out and fishing, they can't do anything while their brothers or whoever are fixing the boats and the nets. So they just got to stand around and do nothing.
Because there's no point in going out and getting rice if there's no fish to make sushi with.
Right, and you can just imagine, you could try to go out in the water with your bare hands and try to grab fish, but that would just be pointless. It'd be better just to sit around reading a book or something. That's just a complete waste of your time. So you're right. That's it. The various sectors don't mesh with each other because one sector grew too much, another one didn't. And then while you're sort of bringing the economy back up to speed, making up for the mistakes of the boom period, there are certain people that just because of their skills and they just can't fit in for a while until the economy recovers. And so, of course, they're the analog of people who are unemployed in a market economy. Mm-hmm. So that was the basic fable or the story to just try to illustrate the highlights of an actual boom-bust cycle. And I did it with specific numbers, and so that's why actually I think Krugman liked that story, is because he could really get his hands around it, because you couldn't just dismiss it as something that was illogical or didn't make sense, because I had actual numbers and said this many people are making sushi on this day, and this is what the output goes up to. So it was a nice little model in the way that Krugman thinks of things, and so that's why he kind of liked the story. Mm-hmm. But the point is, I just spelled it out and showed that this is logically coherent. The Austrians have a point. This might be what's going on in the actual real world when we have large-scale booms and busts. And if the Austrian story is right, well, then the last thing in the world you want to do to try to help during a recession is to have the Fed push interest rates down to zero and have the government spending $2 trillion deficits.
Mm-hmm. And in your example, Paul Krugman barking orders is akin to the Fed lowering the interest rate.
Yeah.
And so, the key problem, as you wrote in your article, is the boom phase. The bust always seems bad because people are unemployed, people have lost income, but the problem is in the boom phase because the market participants, people are getting bad signals from Paul Krugman in the sushi example or the low interest rate in real life. And it's what Austrian economics calls malinvestment. Could you explain that in the context of the sushi story, malinvestment?
Well, sure, yeah, and that's a great point you're raising. I should have emphasized that you're right. In the general Austrian view, the good times are not the boom period. That's when mistakes are being made, and then the bust phase, even though it's unpleasant, is when reality sets in. So it's sort of, people have made analogies to a drug user or something that, when they inject their next fix, they feel good and they feel euphoria, but that's actually they're just making the addiction worse. And then it's when they go cold turkey and they go through withdrawal, that's very painful and unpleasant, but that's actually necessary to get on the road to a true healthy recovery. So yeah, in the sushi story, the malinvestment, the boom period when everyone was eating more sushi, that was occurring because people were not adequately reinvesting in the maintenance of their boats and their nets. They were out trying to expand faster than they really could do so. So it looked like there was this expansion in the output of sushi, and there was, but the point is that wasn't sustainable. And so, people weren't, instead of investing properly in maintaining the boats and the nets, they were sort of, wasting their labor or frittering away their labor in other areas instead of concentrating on what they would need to do to keep the economy sustainable.
Mm-hmm. So in your article, you talked about the nets and the boats. They were being, they became, the nets started to tear and the boats started to break down. And your article, again, for our listeners, it's called The Importance of Capital Theory. So what does this mean? You refer to the nets as a capital good. What does this mean, a capital good?
Well, a capital good means it's something that the humans produce, but it's not a consumption good. So a consumption good is something that directly confers benefits or satisfaction. So, an apple, if you get an apple off a tree and you're holding it, that's a consumption good because you want to eat the apple and that directly satisfies your hunger. Whereas if you're holding an apple seed, that's something that's a production good or, capital good or a natural resource, depending on how you're going to classify it, because you have to go plant it. Or, fertilizer would be a good example. Or a tractor. That's a capital good because you can't eat a tractor, but you use it to then, grow food, which you then can eat, right? So capital goods are things that are useful to humans, but they're like indirectly useful. They're useful because they allow us to produce what are called consumption goods.
So the net, no one would really want the net unless you could actually catch fish because you want to eat the fish. Otherwise, no one would want the net, right?
Right, exactly. So in that story, the fish and the rice are consumer goods or consumption goods because those are valuable, but the net and the boat are just means to an end. The reason people value the nets and the boats is because they allow them to catch more fish per hour.
And for our listeners, this is very important, and we're making a pretty profound idea. We're making it very accessible. So in the sushi example, nets are capital goods. And when Paul Krugman comes along and puts workers into different jobs just because he thinks it's better, he doesn't leave enough workers to maintain the nets, so the nets start to break. And as you said, this is called capital consumption. And again, it sounds complicated, but that's what we've just explained, that the nets are capital goods. And when Paul Krugman or the Fed lowers interest rates and tells people to do things, there's capital consumption. So why is capital consumption bad?
Well, and this is a point that Ludwig von Mises stressed a lot. He says that during when you're trying to understand, well, wait a minute, how can you Austrians say that the boom period isn't good? Because look at everyone, we really are living a higher standard of living. So in the United States, for example, during the housing bubble years, people really were getting SUVs, they were buying huge houses, they were getting plasma screen TVs. Right, so it really did seem like, we were living well from 2003 to 2006, and why wouldn't we want to just keep those good times rolling? And Mises says that because part of what's going on there, when we say it was an illusion, we don't mean that it was all in your head. No, you really were consuming more, but the point is you were doing that at the expense of the capital structure, right? The capital goods in the economy were being eroded, if you will, or not maintained properly, and so it would be physically impossible. We couldn't, in the United States, we couldn't have continued to grow and have our consumption rise year after year the way it happened from 2003 to 2006. It was physically impossible to keep that going, and the reason we got away with it for a few years, according to Austrian economists, is that we were sort of cutting corners with maintaining the capital stock, and that we weren't putting enough resources into the capital structure to keep that going. So again, in relating that to that sushi story, it wasn't an illusion that people really could eat more sushi rolls per day for a little while, but eventually their nets and their boats would be so degraded that then their consumption would drop. So when maybe the better analogy or an easier one is to say the farmer who eats the seed corn, right? So people can relate to that analogy that, you can have a temporary increase in how much corn you eat if you eat the seed corn, but then you have nothing left to plant for next year. And so next year, you're going to starve to death. So that's, just showing the trade-off of you can't consume more than your income. And if you do, what you're actually doing is like eating into your savings. And so in a physical sense, that's what the capital structure is in the economy. It's that when you live too high during the boom phase, you're eating away at the capital structure or the underlying savings.
Well, can you give us a real-life example of capital consumption during the boom years of the business cycle? Something concrete that our listeners could go back and say, oh, this is, there it was the capital consumption.
Well, sure, I'll give it to you two different examples because it's a great question. Because when I had that sushi example, and that's exactly what some of the critics said to me. They said, okay, we understand what you're talking about in the sushi example, and sure, if people don't maintain their nets and their boats, they're going to break down. But come on, in the real world, what happened in 2005? Point to me to what are you saying? Some factory owner, wasn't lubricating the ball bearings in his machinery? What are you talking about? Well, two different examples. So one, in terms of the average U.S. household, a lot of them, if you remember, the savings rate plummeted during the housing boom years. It actually went negative, the U.S. savings rate. And so the way those are calculated, what that meant was, out of workers' standard paychecks and salaries, how much were they putting aside in the bank or in the stock market or whatever, and they're saying that plummeted. But the workers, it's not because they decided all of a sudden they didn't want to save. What was happening is their 401ks were rising very quickly because the stock market was booming, and their house value was rising. So somebody lives in an area where the price per square foot just keeps going up, so they think that the price they could sell their house for is rising at double-digit rates. Well, then your net worth is going up, and so you're not going to save as much out of your paycheck every year because you're thinking, why am I doing that? Because my house is going up by double digits. So it was rational for them not to save as much out of their paychecks because they thought their 401k and their house was going up. But that was an illusion, right? Because then their house plummeted in 2006, 2007, and they slapped their heads saying, oh my gosh, we shouldn't have been spending so much. We shouldn't have been buying so many fancy cars and things the last few years, going out to eat so much. We should have been saving more, putting more in the bank, but we didn't because we
have about a minute left, and I'll let you continue to stop. You have about a minute left, just a heads up.
Okay. And so that there you can see it from the individual household's perspective, like from a financial perspective, that they thought they were wealthier than they were, and really they weren't saving much at all because their portfolios were going to plummet. As far as like physically what was happening, well, it gets a little bit complicated because of international trade. But part of what was going on during those years is Americans were importing a lot of consumption goods from Asia, like cheap electronics goods and cars and things like that, things that would fill the shelves at Walmart too.
Bob, and I'm going to interrupt you real quick. We're going to come back and we're going to reiterate that very important point about real-life examples of capital consumption. So stay with us on RadioFreeMarket.com. We'll be right back. Hello, America. We're back on RadioFreeMarket.com. And, Bob, I'll let you continue that point on real-life examples of capital consumption during the boom years.
Well, sure. So I think I've already explained, how it is from a financial perspective, an individual U.S. household, the sense in which they were living at the expense of their savings, because they weren't contributing as much out of their paychecks in those years as they had before. And people might remember that's when people were worried about the U.S. savings rate dropping, that's part of what was happening there. But in terms of physically, from an engineering standpoint, if you will, what was happening in the economy to explain how we had this period of high consumption that we bought at the expense of the underlying structure of the economy, I think the only way you can answer that is to realize that we had a global economy, and one of the things that was happening in these years is we were importing more and more from abroad. And so specifically what was happening is China was sending us all sorts of goodies like TVs and computers and things like that, and Japan sending cars and so forth. And what we were giving them in exchange was ownership in mortgage-backed securities and in government debt. So we were trading assets, financial assets, to them, and they were sending us goodies that we were consuming. And so that was unsustainable. We were, in a sense, when you say, how are we leveraging our future, well, that was how. And the reason it was unsustainable is that they were doing it for a few years when housing prices kept rising, but over time, we were building, I'm exaggerating a little bit, but there's a lot of truth in it, building McMansions that nobody could afford to live in. right? And if you look at various physical measures like the occupancy rate or the vacancy rate of houses in the United States, it was going down during the housing bubble years because more and more houses were being built that were owned by speculators who were just going to own it for a year and then flip it at a higher price. And so that's the sense in which what was happening in those peak years of the housing boom, you couldn't have just kept that going because more and more of our housing stock was vacant and more of our consumption was being fueled by people making physical things in Asia and sending it to us in return for them owning more and more of the U.S. housing stock. And so as that, that we couldn't have just kept doing that for 20 years because when all is said and done, then the Asians would have owned everything in the United States and nobody would have been living in it. And so it would have been worthless for them to own it, right? So that's the sense in which we could get by for a few years when people misunderstood what was happening, but it was just unsustainable.
Mm-hmm. And Bob, we have about a minute and a half left, and I want to ask you this one question. We'll leave this off. This is very important. We've talked about how the Keynesian-created business cycle really wreaks havoc on everyone. People lose their savings, they lose their assets, their investments, and they become poor. How can a business cycle be stopped?
Well, if the Austrian diagnosis is correct, then the solution is the central bank, the Federal Reserve in the U.S., needs to stop trying to help things by pushing down interest rates. It's the false interest rate that really sets in motion the boom. And so during the recession, the Fed shouldn't be lowering rates to try to provide a soft landing. It should just leave rates alone, stop injecting new money in. The government doesn't need to run massive deficits. It needs to just sit back. If anything, the government, if it wants to help, can cut spending and cut taxes, but let the market just put resources where they need to go to be sustainable. And then we have normal, solid economic growth fueled by real savings, and then that you wouldn't have the business cycle anymore. You'd have a painful adjustment period, but once you got through that, you wouldn't have no more business cycle. That it's the attempt to keep pushing down interest rates and run deficits that fuels a bubble, pushes us up to a high, and then we crash again. And we just keep having that cycle of boom, crash, as the government keeps trying to make up for the previous mistakes.
Mm-hmm. So that's the word, folks. Low interest rates do not help the economy. And thank you, Bob Murphy, for being with us today. This is Aaron Brown and Radio Free Market. Please visit us on the web at radiofreemarket.com, where you can subscribe for free to all of our shows. You can also visit iTunes for our easy downloads. Until next week, wherever you are, please stand up for freedom. Thank you for listening.